quarterly webinar series, Emkay Edge, and it's a pleasure to have you all join us today with us. If I speak about this particular quarter that has gone by, what a tumultuous quarter it was. There's a famous saying in investing: the market is a device for transferring wealth from the impatient to the patient. Yet, staying patient is often the most difficult part of investing. Even every headlines, every market swing, and every new global development test the investor's conviction. So do they for the fund manager's conviction as well. Today, investors find themselves in a very different environment from what we have seen over the past few years. The easy gains from the broad market participation are becoming harder to come by, and the focus is steadily shifting towards quality, discipline, and careful stock selection. In a market where every rally is closely scrutinized and every correction creates fresh debate, successful investing is no longer about reacting to every headline. It's about staying committed to a well-defined investment philosophy. As markets continue to evolve, the conversation among investors has also changed. Instead of asking whether they should invest in equities, the more relevant question today is where to invest within equities. With valuations varying significantly across sectors and companies, identifying businesses with sustainable earnings growth and long-term competitive advantage has become more important than ever. To discuss these themes in greater depth, we are honored to be joined with us by one of the industry's experienced investment professional whose insights have helped investors navigate different market environments with conviction and discipline. It's my pleasure to welcome Mr. Sachin Shah, Executive Director and Fund Manager at Emkay Investment Managers. Sachin sir is a part of MK for past 15 years now, running the show from the front. So many years and many managing capital builder strategies for 13 plus years now. He has a rich experience in capital markets for 2.5 decades now. So thank you for joining us today. We look forward to hear from you.
Thank you, Pritam. Thank you so much. Sincerely appreciate your generous introduction. Good evening, everyone. Thank you so much for joining us. As you know that today we have this, the first quarter has just ended. And what I would do is that we'll run a quick presentation where we will talk about the macros, the demand environment. We'll also talk about my portfolio, how it has performed, and some of the changes that we've done in the portfolio over the this last quarter or so. So let me just quickly share the presentation and then I'll run through you. Yeah. All right. Right. Pritam, hope the presentation is visible.
Yeah, sir, it's visible now.
Okay. Okay. So I just want to slide. Okay, great. So I'm assuming that all of you can see the slide number 2, which is a snapshot about today evening's discussion out there. So what we are going to talk about is how the demand is holding very well in spite of all the Middle East crisis that we saw in the last almost now 4 to 5 months. What we'll also talk about how the earnings trajectory as far as the India Inc. is concerned, Indian corporates are concerned, how they have actually done quite well over the last in the entire financial year 2026. And of course, we'll talk about the current market valuations, multiples, and then of course we'll try to conclude that in terms of our strategy, in terms of our performance of our portfolio. Right. So just to share with some of these data points out here, as you can see, I mean, today we are in this digital world, and a lot of these financial transactions which happen digitally definitely give us a very good cue in terms of the pace of the economy, the entire cycle that the money cycle that's happening in the economy. So you can see here the payment, all the indicators are very, very strong. They are growing at literally 20% YOY, whichever way you want to slice and dice the data, whether it's the RTGS, NEFT, UPI, whether you look at the NACH data across the board. And we've seen this now month after month. It's not a one-off thing. As you can see here, for the last 4 or 5 months, continuously, we are seeing, and we've specifically selected this period because since the Middle East crisis, that the whole point trying to figure out is that how much is it really impacting the domestic demand, the domestic sentiment, if at all. So clearly, we are not seeing any of that sign as far as the spending is happening in the economy across multiple, I would say, points, right? Even if you see from if you try to see even more granular out here, like we are showing here for the last now almost 4 or 5 years, it's even more stronger across the base. Even on larger bases, we are seeing now very high growth of almost 20% every month after month. So this is a very good source of confidence, if I can say that, to get a sense that how the domestic consumer and how the overall domestic demand has remained very, very resilient in a very turmoil global environment, right? So that's definitely one of that. The second part, which again what we are seeing is that the domestic economy, which probably got a huge catalyst post the GST cut, particularly in the month of August 2025, uh, from August 2026, which is the second half of FY26. From there, what we are seeing is that the domestic auto demand has actually picked up very, very strongly. And even more important, what we are seeing here is that the rural side of the demand has come back even more, because that was one area where there has been a lot of lacklusterness for the last 2 3 years. In fact, what we have also seen is that for the last 2 3 years, the rural real wage growth was almost flat to negative, which has actually now turned very, very strong, almost in, I would say, double digits to high single digits, and which is now getting reflected in terms of the spending that is happening on the rural side. So you can see across the category automobile side, whether it is two wheelers, whether it is passenger vehicles, and when it comes to passenger vehicles, like if you read to some of the interviews from the Maruti management, clearly they are saying that the small car segment, which had become extremely stagnant, or in fact which was degrowing for last more than 2 3 years, has recovered very strongly. So, and even of course tractors have been doing very well for more than 3 years now. Similarly, commercial vehicles. So across the board, across all the categories, as far as the automobile is concerned, we have seen a very, very strong pickup. And generally, we all understand that automobiles is the lead indicator for any economy. So this is a very, very positive and encouraging sign that we all are seeing. Even if you just take, I mean, what I showed you was only the rural data, but now if you take the at an OE levels across all the OEs, whether it is two-wheelers, three-wheelers, for commercial vehicles, across tractors, and even if you take rural plus urban both put together at an OE level, we are seeing significant amount of growth coming out here in the first quarter out here. I mean, all of them are growing in the range of at least 20% plus minus, which is a very, very healthy sign to our mind. I think this also gets confirmed from the auto retail sales. So when you look at the FADA retail sales, because what I just showed you earlier was from the OE sales, and then obviously there is sometimes skepticism that maybe the OEs are kind of building up the inventory with the dealers or in the overall system and all of that. But that doesn't seem to be the case. This time there is clear demand, the actual demand from the end consumer, which seems to get reflected in the FADA retail sales as far as the auto is concerned. So you can see that over here also, that if you see the quarter one, and generally quarter one is not expected to be so good, because as we all understand that March quarter is when most of the sales happen. Everybody wants to liquidate their inventory and all of that. So generally the first quarter is a little slow, a bit lackluster. But at this point in time, the demand at the ground level is so strong that even the first quarter has turned out very, very strong for all the auto manufacturers, for all the auto distributors. So volumes are very, very real, and the volume growth is very, very real at this point in time. Some of the other indicators as far as the consumption is concerned are also very clearly telling us. So like if you look at some of the retail, retail stores volume growth, and most of them are actually in the rural, semi-urban rural side. They also continue to show very strong same store sales growth, which is one of the very important indicator as far as the this demand side is concerned. Even from the loan side, the consumer durable loans, which is again a very strong number, because today again a lot of purchasing of consumer durables is happening through the loan segment, thanks to the EMI culture. Very clearly, that is very, very strong. As you can see, both in March and May, we've seen more than 20% kind of growth out there. Again, Phoenix malls, which is largely an urban side of the demand, again there over the consumptions across their malls is growing at upwards of 25-30% over the last 2 quarters or so. So which is again a very, very strong indication that the demand side remains very, very resilient. Now the worry is, of course, will this demand really sustain, and what can actually spook it? So as we all know that there are serious warnings as far as the monsoon is concerned, the El Ninos of the world across many countries, including India. So yes, there is that worry out there. But what we've seen is that in the last few days, this data has improved significantly. So what was probably minus 35, minus 40% deficit at the end of June, and sometime the first week of, or maybe mid of July, we saw probably this deficit come down to minus 20 or minus 23%. And now very recent, as of yesterday, it has come down to only minus 17%. Of course, we also have to see the distribution of that. But again, if you see this chart out here, what it's clearly indicating is that if you see the northwest India and the central India, which is actually the rice bowl as we call it for this country in terms of the food production and all of that, there the deficit is much lower than the India average. And of course, we still have at least 2 more months or maybe 2.5 more months of monsoons. And like as some of us also here, we understand that as per the Hindu calendars, this Adhik Mas, as we call it, may be also playing out for these monsoons to be a bit delayed. So there is a good possibility that this minus 17%, may actually be much more better as we move ahead in the season. So at this point in time, we are not overly worried because the trend is improving week after week on this. Also, the key areas, which is Northwest India, Central India, there the monsoon has already picked up quite significantly if you compare it to what we were, say, end of June or even in the end of first week of July. So that's a very positive sign to our mind. Sorry. Of course, the sowing has been a little slow, but that's always a function of the kind of the rainfall that has happened in the recent times. So our sense is that the sowing progress should actually pick up very significantly in the next 2 weeks or so. So these numbers will also turn much better, sometime in the first week of August or latest by the mid of August, right? But yes, what we are seeing some challenges is that because of this Middle East crisis, we have seen certain challenges as far as on the production side is concerned. There has been decent amount of supply chain disruptions, and particularly to do with products which have linkage with petroleum as their feedstock or raw materials, or somewhere in the value chain. So clearly there they have had some challenges as far as the production side is concerned, and that's why what we are seeing is that the growth over there, what used to be good 20% in that range, seems to be tapering off a bit. Even from the petroleum demand side, you can see that a lot of number of items which were growing in double digit has now come down significantly. So yes, this one challenge. We are hopeful that with the Middle East crisis actually kind of abating a bit. Of course, this remains a volatile situation because till 2 days back, we were feeling that it's much better. But in the last 2 3 days, again the oil prices have risen to almost $100 for Brent, which is not a very, I would say, a very encouraging sign for Indian economy. But broadly, I think there is some. I mean, things are much better compared to what they were two months back or so. So I think we will remain hopeful that if oil prices remain in the range of $80 to $85 or significantly below that, it will be very positive for us. So right now we are seeing some impact of that, whether it's manufacturing PMI in India or across most of the countries. So clearly that's one challenge that we all are facing out here. From that perspective, I think it's a watch and wait kind of a situation. But we are optimistic that if the oil prices actually come down, we will see a much better scenario going ahead. Uh, Flows is something what everybody has been worried about as far as the FII selling or the FPI selling that we all talk about. The way we think about it is here is that FPI is only one part of the flows that come into only one part of the foreign flows. There is another foreign direct investment which is also an important part. So that's been positive for now more than 2 years, as you can see out here, and which really negates a good part of the FPI selling that's happening in the secondary markets. Also, the way to think about it is that a good amount of this FPI selling is also a function of a lot of private equity firms getting their exits from the investments that they have done in some of the new age businesses over the last 5 7 8 years. And if today they have got such good exits and such good returns in Indian equity markets, it's just a question of time that they will come back to India with much more investments, I mean, multiples of those investments, because they have tasted the success out here. They have tasted the kind of the entrepreneurial quality that this country offers, the kind of the market opportunity that this country offers, the kind of the market depth and breadth and the capital markets that it offers. Because investing is one thing, but getting such successful exits, whether it is the Eternals of the world or the Paytms of the world, or whether it is so many other new age businesses across the sectors, where FPIs or the foreign investors or the private equity firms or the venture capital firms, they all have got some amazing beautiful returns over their last 5 7 years of investments. So I'm sure that India will continue to be a very attractive market for them, and they will return investing even with much more larger sums as far as the flows are concerned. Of course, the most important thing is that the domestic flows continue to remain very, very strong. And as you can see across the last 4 5 years, uh, if you see the green bar out there, it is actually significantly so much big compared to both the FPI and net FDI, that actually both those numbers look actually irrelevant in the larger scheme of things, right? That today the domestic mutual funds, the way they are investing, and even if you include the insurance companies, and even if you look at the direct equity investing by the retail investors or large family offices, HNIs, I think that number is so significant now that some bit of FPI selling that we have seen, which today looks like some bit, but would be a large number maybe 5 years, 10 years, 15 years back. But the same number or even a larger number now seems much smaller, only thanks to the large mutual fund inflows that we are seeing month after month. So everything is all a function of in the context. So today the context has completely changed. I think there's a paradigm shift in terms of the domestic savings, the way they have caught on to the equity as an asset class. I think that is something what is very, very positive, the way we think about it. And we believe that this is something which will continue, because the quality of the flows that we are seeing in mutual funds today is very, very strong. It is absolutely non-speculative. It is a truly long-term sticky money. And the fact that today, we have more than 30,000 crores plus SIP coming in every month, and the average SIP value per application out there or per investor out there per month will be in the range of less than 2, 3,000, 4,000 rupees. Effectively, it's so granular, it is so retail, it is so widespread that there is absolutely no concentration risk out there, which is what I was talking about, the quality of the flows. And for these investors, when they are investing anywhere in the range of 25,000 to 50,000, or even say rupees 1 lakh per year, this is truly the way they are approaching. This is as if it's their truly the retirement fund. So they are not thinking about this, returns from this funds over 1 year, 2 year. They really have now taken this view of, taking a 10-year, 15-year, 20-year, 25-year view, and then, revisiting how it is actually done well for them for the equity, for the retirement planning. So I think that's something which is really, really helpful. I think what we've also seen is that overall inflation numbers have remained fairly stable in spite of the some of bit of the jerk on the what do you say, the oil prices. But I think we will still remain in that range of whatever 5, 6, 7%, nothing beyond that, which is reasonable, I would say, for a country like India. We need some inflation for our high growth aspirations. So I think overall, on the macro side, things seem to be fairly stable. That's how we are approaching things. I was also talking about in terms of the earnings growth that we have seen. So if you look at the FY26, clearly the earnings trajectory has improved significantly over the FY25, and this has happened across large caps, mid caps, and small caps. As you can see, the earnings growth is good 10-12%. EBITDA growth is even better in the range of 13 to 20%, but broadly at least I would say 15, 16, 17% plus minus. And the bottom line growth is also in the range of whatever that 18, 20% across, right? So this is a very, very strong based foundation that has got created for the capexes that will happen in this country, because as the Indian corporates have made decent profits, they have decent cash flows, and also let me tell you that these profits are very, very high quality profits, because thanks to COVID, most of these corporates actually got their balance sheets very much in order, right? Because they actually controlled their working capital. They did not do any significant amount of capexes over the last 2-3 years, so they just kind of debottleneck some of their capacities. They did some brownfield. There was no hardly any greenfield expansion. So today the quality of these profits is very, very high, because most of these profits are getting converted into decent amount of cash flows, which allows these corporates now to think about doing capex. Also, there is decent amount of credit available, and we can also see some bit of credit pickup now, as currently the overall credit growth is now at, I think, almost last 4 or 5 year high at almost 15-16%, which is very strong, which is also indicative of the kind of the demand that we are seeing at the ground level, both on the consumption side and also on the corporate side. So what we believe is that today capacity utilizations for most of the sectors are reaching in the range of 85 to 90%. And today corporates will have to create capacities. But the good part is that to create these capacities, they have the cash flows, they have the backup, they have the supporting from there, and also the banks are ready to lend them. So I think we are getting into that sweet spot where we will actually be seeing decent amount of private capex happening over the next 12 to 36 months, which is what this picture is really indicating to us out here, right? You can also see that how interest rates have actually moved across all the countries from the last war day, so which is say sometime end of February or early March. India has also broadly moved in line. As you can see, 13 bips versus 55 or 48 bips over 42 over a longer period of time also. So from that perspective, I think that Indian bond yields have behaved fairly maturely over these last 3-4 months. So I think that's again a very, very good sign as far as the domestic liquidity is concerned. as far as the confidence in the overall economy is concerned, the sentiment in the economy is concerned. So all of that seems to be fairly stable. We continue to remain in this 6.7, 6.8 kind of a 10-year GSEC, which is very healthy to my mind on a very stable basis. Coming to the overall current valuations in the market, I think they're very, very reasonable. Yes, they will not be very cheap like they were about 2 months back, sometime in March, the end of March, because that was the time when we reached almost a 20-year average, which is under 20 times or in the range of 20 to 21 times. Over the last 3 or 4 months, we've seen a decent bounce back in the market by almost 12 to 13% gain. We got a first bounce in April. May was more or less flat. Again, June was decent. July, I think, is flat so far. But broadly speaking, I think if you see in the current financial year, markets are up almost 12% plus, and this is just the large cap Nifty. But if you look at the mid and small, I think we are up 25% plus. But if you just look at the pure Nifty valuations also out here, clearly we are at a 15-year average, so very, very reasonable valuations, and particularly in the context where I'm saying that the earnings growth trajectory is looking very strong over the next 12, 18, 24 months. Clearly, even if you think about it from a the relative valuation to the bonds, right? So whenever we have seen that the spread between the 10-year GSEC and the earnings yield is just about 220 odd bips. It's a fairly attractive time to actually allocate money to equities over debt, because more than 95% of the times equities have traded expensive relative to debt. So it is you are actually in that sweet spot. At least over the last 5 years, that has been the case. If you take this to over last 15 years, then nearly 70% of the times equities have traded more expensive relative to the debt. So you are in that sweet spot of that 15, 20, 25% period when equities would have traded in this range or maybe little more attractive. But today, as I said, that it's a very fair valuation. The risk reward is in favor of the investors. I think even risk adjusted returns, one may look at and think about it. It's fairly good. So I think overall we believe that it's a very healthy valuations, very healthy market at this point in time. If one is able to invest in good quality resilient businesses, there's a decent chance of making mid-teens kind of returns over the next 2, 3, 4 years. So that was all about what I wanted to share in terms of the current environment, in terms of the demand side, in terms of the valuations. So I just think that maybe now we can probably move to the MK Capital Builder strategy that I have been managing for the last 13 plus years. As you all know that this is a flexi cap strategy. We invest across sectors. We are fairly sector agnostic. We invest across large cap, mid cap, small caps. At the same time, it's a very, very focused portfolio with just about 20 odd stocks. 18 to 22 has always remained our sweet spot. And I think over the last 13 years, we've done a very decent job. But returns is, of course, only one side of the coin. Most important, our risk-adjusted returns are even more superior. The beta of our portfolio across time frames have remained in the range of 0.85 to 0.9. Our standard deviations have also remained fairly, I would say, fairly lower than the markets, which makes most of our risk-adjusted returns far more superior. And of course, returns have been very good. So like we've delivered nearly 16% compounded returns over the last 13 and a half years now, which means our 100 has grown to 700, 7 times literally over this last 13 plus years, right? And of course, if you see the last 1 year, 2 year, 3 year, 5 years also, in fact, the 3 year, 5 year, and since inception, all three coincidentally today give us nearly 16% kind of compounded return, beating the benchmark indices, BSE 500 TRI, And also, even if you look from a passive funds or whichever way, I think Nifty 50 TRI, we've done a fairly good job. We've delivered literally 20% more returns over the BSE 500 TRI and 52% more returns over the Nifty 50 TRI on the total return basis over the last 13 plus years. Uh, it's a very very liquid portfolio. These are some of our large top holdings. We have, as I said, just about 20 odd stocks. It is spread across sectors: automobiles, healthcare, financial services, IT, e-commerce, and some of the other businesses. At this point in time, in terms of our allocation, and since this is a flexi cap, this allocation keeps on changing. So at this point in time, our large cap allocation is just about 60 odd percent. Mid and small is almost about 40 odd percent. If, as some of you might be following us for a while, you know this, that end of March 2026, which means exactly 1 quarter back, the large caps were as high as 70 to 73%, and we were just about maybe 60 to 63% kind of large caps about 18 months back, which over the last 18 months we kept on increasing to probably about 70 to 73%. But in the last quarter or so, we've gone again more towards mid and small. This is a function of the opportunity that the market is offering us at different points in time, right? And that's the advantage that we have being a flexi cap fund, where we can actually allocate money, whether it's a large, mid, or small, depending on the risk reward, depending on the return expectations that one can have from the current valuations within the large, mid, and small, and of course specific businesses. So I think thanks to the kind of the sharp fall that we saw in the month of February and March 2026, particularly in the mid and small, many of our businesses actually came into the valuation parameters where we were happy to invest, where we felt that now the time correction, the value correction over the last 18 months in those mid and small cap companies have actually come to a point where they have become very very interesting for long term investors like us. So that's where we've actually increased our allocation to mid and small over the last I would say 3-4 months. Otherwise, this portfolio continues to remain very very liquid with an average market cap of almost 3 lakh crores. Very very high quality portfolio, as you can see in terms of our equal score. Again, equal is one of our proprietary modules where we actually evaluate management quality in a very very objective basis. So it literally has a 78% at a portfolio level, which actually is very very good to my mind. Generally, out of 100, 78% is very good at a portfolio level. So many of our companies will actually have 85 to 90% kind of rating out there. So that gives us a lot of comfort that in terms of the returns, they are very very high quality way of generating returns. Also, just to share with you some of the changes that we've made in our portfolio in the last quarter or so. What we've done is that we've added 4 new businesses. As again, many of you would know that we generally don't have too many changes in our portfolio. This is one of those quarters where we've had decent amount of changes in our portfolio. So I just thought that we should share with you some of our thoughts out there. So as you can see, we've added 4 new businesses. In fact, all 4 in completely different sectors. We've added Akums Drugs, we've added Godrej Consumer, we've added Home First Finance and Interglobe Aviation, which is Indigo, right? The Indigo Airlines. Now, Akums Drugs is a contract manufacturing pharma business. They basically do contract manufacturing for most of in fact, all the top 20 domestic pharma companies. So whether it is Sun Pharma, Dr. Reddy, Cipla, Abbott, some of the multinational companies which are present in India, they actually do business with them. I mean, they actually manufacture medicines for all of them and supply to them. And they've been doing this business for decades. They are literally the market leader out there. They have more than 30% market share in the outsourced manufacturing market from the domestic pharma companies. And the domestic pharma companies overall actually outsource their manufacturing by nearly 30%. So if you take the 30 of 30, literally you can say that 10% of India's drugs consumed are actually manufactured by Akums Drugs. So they're fairly large, they're leaders, they are very high quality businesses, again run by very high integrity promoter family, if I can use that word, and of course also professional. Their manufacturing capabilities, their manufacturing capacities that they have created are literally world class. And I think the proof of the pudding is that in the recent times they've now got contracts from some global companies. So about maybe about 6 months back, or in the range of 6 to 9 months back, they got a contract from a European pharma company to do contract manufacturing for that company. And it's a fairly large order because that the global company gave them an advance of nearly rupees 700 crores to set up the capacities and supply to them. So that's the kind of the confidence that they've earned now, not only from the large domestic pharma companies but also from the global pharma companies. So that's just the beginning, but that definitely opens a very large market for this company. Godrej Consumer, again, I'm sure most of you know I mean, you know this business, you know, some of the products, whether it is the bar soap, which is the Synthols of the world, or some of the home, you know, insecticide products. So all of, I mean, the Good Night and those kind of things. So this is a company which again has been there for a while. We believe that there are a few products that they have actually entered into, which is where that inflection point is coming, and which is where their growth will get accelerated over the next 2 to 3 years, right? So we believe that Godrej Consumer is something where, and of course this also is an important play where I was talking about the rural side of the recovery, right? We have already seen decent amount of green shoots coming back for the rural demand. So we believe that Godrej Consumer is a very good play as far as the rural demand, you know, is going to rebound from there. The other is Home First Finance. This is an affordable housing play. They typically finance houses which are an average ticket size of about 25 to 30 lakhs, where they give a loan value in the range of about 10 to 15 lakhs. This is a company which is growing at almost 25%. But more important is that over the last few years, when they have had such high growth, they have managed to keep their asset quality absolutely pristine. There has been no challenges as far as their asset quality is concerned, and which is, to our mind, one of the most important parameters for any lending business. Doing high growth is not a very difficult thing as far as lending is concerned. There are enough borrowers in any economy, but it's all about whom are you lending to, how are you ensuring your collections. Also important is that today in the competitive landscape that we have, because there's enough competition in the housing finance business, there is enough competition even in the affordable housing. So to acquire customers and acquire quality customers, and also acquire quality customers at a low cost in terms of your operations cost, right? Your OPEX has to be very controlled. So Home First Finance has deployed some very unique strategies in terms of connectors, where they use ground level, I would say people, and with the technology support that they have given to them. And these connectors are not actually the employees of Home First Finance. They are kind of, you can say, they're representatives who are paid on references and on the success of those references. So as that connector model has actually worked very well for them, and of course they have used technology beautifully to actually play that out. So Home First Finance is again an affordable housing segment, again part of that semi-urban rural area, because I'm sure, as you can imagine, that today to buy a house or a construct a house with 25-30 lakh rupees, it's almost not possible in a urban kind of or even a tier 1. So it's largely a tier 2, tier 3, or a rural kind of a story out there. The other, of course, is Indigo. So all of us know that Indigo is virtually having 65% market share as far as the domestic airline business is concerned. Our sense is that they will continue to maintain this leadership simply because the kind of the capacity that they have created as far as the aircrafts are concerned. I mean, it's almost unparalleled today. And what we are seeing at a global level, that the aircraft supplies have become very challenging in terms of procuring new aircrafts is a very slow process, and for at least next 2 3 4 5 years this doesn't seem to be changing very quickly, particularly because of the challenges that we have seen with Boeing. So from that perspective, I think the Indigo will continue to maintain their leadership as far as the domestic domestic air passenger travel is concerned. But also more important is that Indigo is now actually moving into in fact they've already moved into international market for the last few years, but that pace is now accelerating. They are clearly now more and more focused over there. So our sense is that the incremental revenue from the international side is going to be very strong for Indigo Airlines. In fact, they will really diversify themselves. I mean, more than 25 to 30% of their revenues over the next 3 years will probably be actually coming from the international side. And again, they will do destinations where typically we as Indians or overall large crowd within India will be actually flying there. So whether it is Southeast Asia, whether it is some of the countries in Far East Asia, so or the Middle East. So all these places where is a large chunk of the India's international passenger are actually traveling out there. So and that is a fairly, I mean, it's a much more profitable business also compared to a domestic air passenger traffic, because on the domestic air passenger, when you are addressing a much larger crowd, a much larger audience, the pricing power will remain limited. Whereas on the international side, you have a much better pricing, you have much better yields, which is where we believe that the volume growth, of course, is going to remain strong for Indigo over the next 2 3 years. But the profitability and the profit growth will be much better or much higher over the next 3 years. Inherently, we believe that this company, the machinery or the overall whatever that they have created has a potential of generating at least 10,000 crores of profit on an annual basis, right? Of course, the current environment is a bit, I would say, not very favorable for airlines, thanks to the oil prices, and not only that, thanks to the Middle East crisis, the tourism has got impacted significantly. But these are phases. We believe that over one or two quarters, that doesn't change the inherent strength of the business, that doesn't change the inherent intrinsic value of these businesses. And actually these are times where, thanks to the stock prices coming down significantly, they create opportunities for long-term investors like us. So these are four businesses that we've actually added over this last quarter. What we've exited is three businesses. In fact, one is a partial exit and the other two are full exits. What we've exited partially is Sun Pharma. So we continue to remain actually very positive on the business. The domestic formulations business, they are the market leaders with almost 10-11% market share with very high margins. It's an extremely highly profitable business, very high cash flows for Sun Pharma, and that leadership continues to remain as strong as it was, or probably the strongest in last so many years, and there's no reason to believe that they are getting complacent about it. Also, the US specialty business, which is largely the patented product kind of business, I think they're doing very well. In fact, they crossed more than $1 billion revenues out there in FY 2026. Again, very profitable now because they have achieved that scale of more than $1 billion. I think they did almost $1.2 billion of revenue from that US specialty business, which is again one of its kind from the Indian pharma side, right? I think probably the only Indian pharma company which has got this success as far as the US specialty business is concerned. Their global specialty business revenues, as I said, have now crossed $1.2 billion, and with that scale, it's become fairly profitable. Uh, the only reason why we have done our partial exit or partial reduction in our weight is because we have a very strong discipline in terms of our investment process, right? And one of those processes is that wherever a large company does a whenever any company does a large acquisition, and what is a large acquisition? If it's more than 50% of your current balance sheet size, we generally avoid investing in those companies, or we become very cautious investing in those companies for the at least first year of their acquisition. After the 12 months have passed, we are happy to revisit that company and figure out, is the acquisition actually playing out the way it was anticipated, or is the acquisition becoming a drag or a burden on the core business, or the business which is generating strong cash flows. And we've seen this in the past more often than not in most of the sectors, with some of the best of the companies, best of large businesses. Wherever large acquisitions have been done, they have been drags for years and years. So, as an investment process, as a risk management, we try to reduce our weights there, or we try to exit those businesses, and we'll try to look for alternate businesses where we don't worry about this kind of things. So that's the only challenge that we've seen in Sun Pharma, because as you all know that they have recently announced a very large acquisition. Of course, that acquisition on the face of it at this point in time also looks very, very positive. They have entered a new segment as far as the business is concerned, particularly on the women healthcare side. That business has again strong profitability, but that business also has very high debt, to the extent of, I think, almost $8 billion, which is almost 80,000 rupees, 80,000 crores of debt, which will come to the Sun Pharma's consolidated balance sheet. So we will have to see how these things play out over the next 12 to 15 months. Is Sun Pharma able to do this integration? Is it able to maneuver this business in the right direction and manage it well along with the debt, is something what we would like to wait and watch. The other two businesses that we have fully exited, one is Mahindra Holidays, another is Gujarat Pipavav Port. Mahindra Holidays we've exited because over the last 12 to 15 months, the management has kind of, there is some bit of change as far as their strategy is concerned, as far as their business strategy is concerned. They are trying to do something which is actually very good in the long term of the business. But of course, the proof of the pudding will be in terms of their execution, right? They are basically trying to say that instead of a very push kind of a strategy to get new members or to get their new customers, they want to have a pull strategy, which is try to create a very fantastic product or a fantastic service, which will help them, make much better profits over a longer period of time. Also, they want to get into from just a pure vacation ownership business as far as the holidays business is concerned, or the leisure hotels is concerned. They also want to now get into pure hotels, like a typical hotel business, and also allow non-members to be part of their properties. So again, these are some of the I would say some very different or a very strategic changes that the management has actually made. So whenever this kind of changes are made, we would like to wait. How are they actually getting implemented? How are they getting actually well executed? And most important, are they getting reciprocated better or well from the consumer or their customer side? So again, as a cautious thing, we have exited this business. It will continue to remain on our tracking list. But we just thought that we should look at better alternatives where we have better visibility as far as the short to medium term is concerned. We've also exited Gujarat Pipavav Port. This is the business which again is actually very strong business, generates more than 500 crores of free cash flow every year. This is the business which actually has one of the probably only infrastructure company in the country which has zero debt, which generates free cash flow. But the only challenge has been in terms of their growth. So over the last 2, 3, 4 years, their growth has been fairly subpar. I mean, I would say low single digits or just about there, which is something what we don't really appreciate. And there has been, and why this growth has been very low. There could be multiple reasons because of the external environment. Like we had an environment of COVID, we had some slowdown of economy about a couple of years back, and a lot of those challenges. But also, I think some bit to do with because there are challenges in terms of where they are also probably not doing incremental capex because they are not getting clear visibility as far as their concession agreement is concerned. So their concession agreement expires sometime in September 2028. Beyond that, it is the new Gujarat maritime policy which will decide whether they will continue to be the operator of this port or it will go to some another operator. That uncertainty has now lingered for a fairly long period of time, and now we are probably less than 2 years away from that concession getting expired. So we just thought again, we don't want to get into a situation where it becomes very sticky and where it becomes difficult for us to execute. So, keeping again looking at alternate medium-term opportunities, we have made this change out there. So this is what we've done. Overall, we believe that, as I mentioned earlier, that clearly the consumption remains fairly strong, resilient across rural, urban, across categories of products, whether it is auto and overall other consumption. We believe the corporate earnings growth also have remained very strong. The only challenge at this point in time, or the only worry at this point in time, remains monsoons, which again we've seen a very improving trend over the last couple of weeks. So fairly hopeful, fingers crossed. Uh, if at all, I think even more than the monsoons, if my personal take is, my only worry is the oil prices, which was not a worry till 2 days back. It's again probably got to that level, but I'm fairly hopeful that the way the situation is, I think the worst is behind as far as the Middle East crisis is concerned, or even more important as far as the oil prices are concerned, because the supply is increasing significantly. We have seen how there has been a split in the OPEC members. We are seeing how India as a country is trying to create strategic relationships with some of the Middle Eastern countries, and those countries actually are thinking of actually, like UAE is actually thinking of increasing their output significantly, like from a 1.5 million barrels per day to almost 3.5 million barrels per day. And with India's very strong and good relations with those kind of countries, I think we should not be in a problem. Most important, as I said, as the supply keeps on flowing more and more from more and more countries in the global oil markets, I think there's a good possibility that on a sustainable basis, oil prices should remain probably in the definitely below 80 to $85. It can be 60, can it be 50? I don't know. My point is that as long as they are in the range of sub $80, whatever that number is, but as long as they are in that range of 80, 85 or sub below that, it is fairly positive for India because our tolerance level, our inflation, everything remains under control at that point in time. So I think I'm fairly optimistic going ahead. Plus the valuations have become very, very reasonable. And as we all understand that typically markets always climbs the wall of the worries. So this is where you get the very reasonable valuations, and from that perspective, I think these are good times to actually allocate more money to equities. I think I'll take a pause here, and we'll open up for some Q&A. We'll try to make this as interactive as possible. Thank you very much for your patient hearing. Pritam, over to
Yeah,
you.
thank you so much, sir. I mean, it was always a pleasure listening to you, especially when it comes to focus approach. Generating returns, consistent returns is not easy as it seems, but yeah, we've seen you making it possible with your discipline. We can now move on to the Q&A session. So I request participants to please drop your questions in the Q&A box, which sir would be answering. So in the meanwhile, I have a couple of questions, so I think we can take those.
Sure.
Yeah, so sir, we saw a good amount of recovery in Q1 vis-a-vis the dip which we saw starting from Feb till March. Currently, the markets are still volatile because of the global uncertainties, be it war or Mr. Trump. Where do you see markets moving from here as far as, I mean, this war is concerned?
See, Pritham, like I said, that I am not overly worried at this point in time. I think the worst is behind as far as the Middle East crisis is concerned, particularly with the oil prices, and that is what matters to India as an economy. I strongly believe that on a sustainable basis, the oil prices will remain sub 80, $85. I think the valuations today are very, very reasonable for Indian equities. Like I just was trying to show out there in terms of on an absolute basis, we are at 15-year average. Uh, we are at even if on a relative basis to the bond yields, we are much better than the more than 75 to 90% of the times on a 5 year or a 15-year period, whichever way you want to take about it. So I think we are and there are enough opportunities across large, mid, and small. We are in the midst of the quarter one earnings right now, and most of the earnings have remained actually very, very strong. We've hardly seen any disappointments across most of the companies or the sectors as far as the earnings growth is concerned. So I think that's again because actually Q1 was not expected to be so strong because we all expected that the challenge, the Middle East crisis, the raw material impact or some demand impact or wherever whatever you want to talk about it will probably get reflected in the Q1 earnings season. So far, we've not seen any of that. We are seeing there is demand resilience from the consumer side. We have seen decent amount of growth coming in. We have seen decent amount of profitability uh, declared by the corporates. So I'm extremely positive. I believe the next 12 to 24 months, as I said, the equity should deliver returns at least in mid-teens or so.
Correct. Understood, sir.
Mm.
Where do you specifically see opportunity lying in broader markets? I mean, any sector specific?
Like again, my actions speak out there. My allocations to mid and small has increased over the last 3 months or so, last 3 to 4 months. We've increased our allocations from almost, I would say, less than 30% to now as high as 40% over the mid and small. Clearly out there. And also some of the businesses that we've added out there, which means that we've added into uh, in affordable housing finance. So financial services is one space where we believe today the valuations are very, very reasonable. And more importantly, quality financial services are available at very, very high, very, very reasonable valuations. And we also believe that the growth in those sectors is going to be fairly strong. We have a fairly high allocation to the pharma sector. And we in fact continue to remain there again very strong. Although we reduced weight in one pharma business, but we've simultaneously added a new name within the pharma sector, which is again speaks of our view on the pharma sector outlook for the next at least 12 to 18 months. Also, we've added the two consumer businesses out there. Again, and most, I mean, one is the discretionary consumption and the other is a semi-discretionary consumption. So again, that speaks of the rural recovery that we are talking about, rural semi-urban recovery, and also overall the urban demand, which has remained fairly resilient. So I think we strongly believe that these are some of the sectors where the outlook is very, very positive. It's just a question of maybe some of these headline news, particularly on the global geopolitical challenges, waning out, and we will see markets actually uh, seeing very, very strong rebound.
Understood, sir. I mean, you were mentioning about oil prices. We are hopeful that the oil prices remain in between 80 to 85. But if the crude oil prices continue to remain elevated for, let's say, coming months, won't it be a meaningful risk to India's earnings growth and market valuations? Or do you still believe that economy is better equipped to absorb such shocks today?
No, like I was trying to tell you earlier that I think the for the current GDP growth, for the current corporate earnings growth, whatever we are talking about 15, 18, 20%, or a GDP growth of real GDP growth of 7%, nominal GDP growth of anywhere between 11, 12%. I think it is pertinent that oil prices remain in this range of sub 80 to $85. Yes, if the oil prices go to $100 plus or something like that, and if it sustains there for say 6 to 12 months, it will have an impact, particularly inflationary impact, and because of that inflationary impact, we will have certain challenges as far as the demand side is also concerned. Yes, it will definitely. I mean, the impact may remain there for 1 year, 2 years, but over again, if you take 3, 5 years, I think we will again readjust ourselves to that. But I think more important to think about it is that in all probability, I believe that oil prices are not sustainable at $100 simply because the kind of the supply that we have seen in the last 3, 4 months during the Middle East crisis is very encouraging to say that the oil prices will actually go significantly lower as soon as there is some of this global headline news kind of cool off. So on a sustainable basis, to my mind, oil prices over the next 12 months, 18 months, 24 months, 36 months, or even longer should actually remain significantly below sub 80 to $85.
Fair enough. Got your point, sir. So there is a question from a participant. The name is not mentioned. It is about the mid cap. So his question is large caps from 70% to 60% which is the change that you have made in the portfolio doesn't seem like a significant shift out of large caps. Also, from EBITDA and PAT and revenue growth looking strongest in mid caps, the allocation is still the lowest at 14.7%. Would you change that in near future?
See, again, earnings growth is only one side of the coin. The other side of the coin is always the valuations, right? So typically, it's also, see, today Nifty mid cap index is at all-time high. So as you can imagine that they are most expensive today in the market relative to the large caps and the small caps, right? So I think what is also important is not only growth, but can that growth actually help me as an investor to make my returns, or is it already in the price, right? So the way we think about it is that we love growth, but we have to buy them at reasonable valuations which allow us to make decent returns over a period of time. And from that perspective, we've increased allocations to small caps, and we've also added some mid caps, I would say. So but I think 70% to 60% large cap allocation is a significant reduction. I think at this point in time, we are very comfortable with the allocation that we've had. Maybe we will go down to 55% large cap, but the way we construct our portfolio, it is embedded that we have this discipline of at least 50 to 55% large caps, because as I said, we don't have more than 18 to 22 stocks typically. At the same time, to avoid any concentration risk, we have allocation disciplines in place. And what are these allocation disciplines in place? That no single stock will be more than 7.5 to 10% if it's large cap, not more than 5 to 7.5% if it's mid cap, and not more than 2.5 to 5% if it is small cap. Right now, if my allocation limit for a small cap company is just about 2.5 to 5%, which say about an average 3.5% plus minus, and if I don't want to have more than 20 odd stocks in a portfolio, I can only have so much small cap allocation or mid cap allocation at any point in time. I will need to have large cap stocks, otherwise my number of stocks will increase. So to remain a focused portfolio and have allocation discipline, what my experience of last so many years, since last more than 13 years that I'm in managing, my large cap allocations typically move in the range of 50 to 55% to as high as 75%. Today we are almost there at 60%, maybe another 2, 3, 5% depending on the opportunity in the market. But let me also emphasize, this is one of the phases in the market, and which is not very common actually in my last so many quarters that I have been managing money. This is one phase where we are finding opportunities across large, mid, and small. What we have seen in the past is that markets actually give you opportunities in phases, where there's a phase where the majority of the market where mid and small are very attractive as far as valuations are concerned. There's a phase where large caps are much more value. I mean, attractive on a relative valuation to a mid and small, right? But currently, the way I'm seeing, we are seeing opportunities across large, mid, and small. So I think the current allocation, I'm very comfortable.
I hope his question has been answered. Sir, I had a question. I mean, we have seen Eternal recently reported its quarter one results, and the numbers have attracted significant investors' attention. We have seen 3% jump in Eternal stock prices, reporting a net profit of 92 crores, Blinkit moving from a large loss last year to a meaningful profit. With the increase in the stores in Blinkit and profitability coming in, do you think it could prove to be one of the greatest move of the company?
See, I think most important, if you see the way the Blinkit and both Zomato and Blinkit numbers have been actually getting delivered, I think it's one of its rare kind of execution that I have seen in the corporate world, right? You need some crazy kind of execution rigor, and which they have actually delivered. Because today the run rate of Zomato, which is just the food delivery business, on a quarterly basis is 10,000 crores. They actually go and deliver food worth 10,000 crores every quarter, which means now they've hit a run rate of 40,000 crore worth of sales or revenue, not revenue, but in terms of what they are actually delivering to the doorsteps to you and me, right? Similarly, if you look at the Blinkit, which is largely a grocery and a food, fruits and vegetables kind of a business, that has now hit a run rate of 17,000 crores a quarter, right? Which means they'll probably cross at least 75 to 80,000 crore of revenue, not revenue, but the worth of goods that they are actually delivering to the doorsteps, right? And the number of monthly transaction users have also crossed more than now, I mean, almost 3 crores per month, right? So it's a crazy execution rigor that they have delivered, right? Just to put things in context, Hindustan Unilever's revenue at this point in time is just about 65-70,000 crores. DMart revenues for this year will also not be more than 75-80,000 crores. DMart is probably less than, I mean, it's about 15-20 year old business. Hindustan Unilever must be more than 60-70-80 year old business. Blinkit is probably less than 5 year old business, right? They've already achieved this kind of scale, right? What I'm trying to tell you is the consumer has embraced them fully. They have reciprocated it big time with amazing execution rigor, right? So with this kind of size and scale now, and with the kind of the discipline that they have showed in terms of their cost of doing the business, I think, I mean, unless something really goes off, there is a very high probability that they will deliver some amazing profits over the next 2-3 years. By the way, on the food delivery, they already are now delivering 600 crores of operating profit on a quarterly basis. Effectively, on a full year basis, they will do probably 2,500 to 3,000 crores of operating profit just this current financial year from the food delivery business. And on the Blinkit, I think you will see much higher numbers over the next 2-3 years.
Really amazed to know that, sir. Since we are speaking about stocks, I had one question, and I mean, coincidentally, our participant also has a similar question. So, considering what is going on in HDFC Bank, I mean, it is under pressure after the legal probe into investors' disclosure claims. What would be your take on it, and how do you see this particular bank?
Yeah, so headline news is one part, but look at the quarterly results that they have declared. They've just come out with the Q1 results. They continue to grow at almost 14-15% as far as their both the asset and the liabilities are concerned, right? Which is the deposits and the loan book growth, right? They continue to grow in that range of whatever 13, 14, 15%. Again, very strong, largest private sector bank and maybe number two bank in the country as a whole. I mean, after State Bank of India in the size, right? Profitability wise, they're by far the largest. They delivered 75,000 crores of profit, FY26 historical number. I think this quarter they delivered close to about 19,000 crores of profit already in Q1, which means for them to do about close to 85,000 crores of profit on an annual basis is not a very big challenge. And March 28, can they do 1 lakh crores of profit? I think high probability, right? Asset quality, absolutely pristine. There is no challenge as far as the asset quality is concerned. The numbers are in front in the public domain for everybody to see that, right? They have very clearly indicated that their profitability will improve even further over the next 12 to 18 months, because their liability cost, which is their cost of deposits, will keep on reducing, because there is going to be repricing of the deposits which they have actually got from HDFC Limited, because HDFC Limited deposits were at higher cost. Now, as and when they get matured and they get converted into HDFC Bank deposits, they are at much lower cost, right? Similarly, they are also improving their mix on more on the retail loan side for the next 2-3 years, because for the last 12 to 24 months they had slowed down that, looking at the environment. Now they have become fairly positive on the ground level environment. So as they keep on improving their mix more on the retail loan side, their yields will also improve. Effectively, their spreads will improve both from the yields and the cost of side, on the cost of fund side. Profitability will improve. Their asset quality remains very pristine. And most important, the current valuations. Thanks to all the headlines that we've seen, the value, and of course the FPI selling that we saw in the month of February, March, there has been a significant amount of compression on the valuations of the HDFC Bank, right? Today it's probably trading at maybe 11 to 12 lakh crore. I mean, less than, definitely 11 to 11 and a half lakh crore kind of market cap. And their subsidiary value, which is say the HDFC Life and HDFC AMC, all put together for their equity shareholding, will be in the range of at least 1 to 1.5 lakh crore. What I'm trying to tell you here is that the HDFC Bank core business, just the HDFC Bank standalone business, we are getting for rupees 10 lakh crores. For a company or for a franchisee that will deliver close to 1 lakh crore plus minus profit in the next 21 months, March 28. We are just 21 months away from that. You're buying this franchisee for 10 times. Now, this is exactly what I was trying to tell you earlier also in the context when you asked me large cap versus mid cap. So even in large caps, and this is a mega cap, even if I can use that word, you are getting a business with such a strong franchisee for 10 times. So that's how I think about it, the risk adjusted. And when I say 10 times, which means that it's not only, I mean, it is quality. There's no compromise on the quality to my mind, but there is also growth, because we are talking about 75,000 crore profit in March 26, going to probably 1 lakh crore by March 28.
Agreed, sir. I think that's the reason why I believe you have increased the weights from 8.5% to 10% now in this particular stock. Sir, another question. I mean, the IT sector has been under pressure for some time now. Do you believe the worst is behind us, or should investors remain cautious? How are you looking at this particular sector from a long-term perspective, since they've corrected so much? Should one buy and hold from here?
So, it's a very tricky situation, to be very honest, right? In fact, we have reduced our weight in IT from the last quarter to almost, I think we did that in previous quarter itself, from 15% to almost 10% now. We've done that as a risk management policy. Let me tell you on the both on the positives and the negatives, what is going for IT as a sector today. On the positive side, again, very evident, your valuations are extremely reasonable. You're getting most of these franchises which generate profits in the range of 10,000 crores to as high as 50,000 crores. That's like TCS does 50,000 crores. Companies like HCL Tech does about 14, 15, or maybe almost 17,000 crores of PAT. Infosys does close to 30 to 40,000 crores of PAT. Even Wipro does about 10 to 12,000 crores of PAT. So all that range, you're getting these companies in the range of 12, 13, 14 times. But the challenge is, will this profit sustain? Will this profits grow? That is the real question. Like I was very confident on HDFC Bank. I believe the profits will not only sustain, but they will grow over the next 2-3 years. As far as the IT sector is concerned, that's a big question mark at this point in time. And what is the worry? The worry is the AI disruption. Will their customers not need them as much? Will their customers reduce their work because AI can actually do a lot of work what these IT services companies were doing all this while? So these are big questions that we have to grapple with, right? Because this has been the headlines globally from all the AI companies. whether it's OpenAI, whether it's Claude, whether it's Palantir, whichever way you want to think about it. I mean, these are challenges that we are worried about. Now, the way we are thinking about it is that there are two or three things out here. The last 2 years, we have seen the order wins of all these large IT companies being very, very strong, right? So their customers still continue to engage with them, continue to give them orders, but the execution of these orders have actually been a bit slow, right? And that is why you're not seeing the revenue growth. What I'm trying to tell you, the last 2 years, the revenue growth has not been in line with the order win growth. So where is the disconnect? So our sense is it's nothing to do with so much with AI. It's more to do with, if you see the last 24 months, the event after event, there has been serious challenges. And what are these challenges? If you think about it, about almost 24 months back, there was a worry in the US markets or in the global environment that the US economy will have a hard landing. After that, we had serious challenge as far as the tariffs are concerned, the tariff war or the real worry. So that became huge uncertainty for most of the global companies in operating in the global landscape, right? That how will these tariffs impact their businesses and so many things. So all of this meant that these companies actually wanted to create war chest. They reduced their spending significantly, particularly discretionary spending, and they started creating cash in their balance sheets, right? After that, we had this Middle East crisis, right? And then, of course, this AI narrative, at least, so which has kept a lot of things on hold, right? Our sense is that this can't get postponed beyond a point because today the customers, the consumers have embraced the digital economy, which means these companies will have to invest in becoming much more digital because their entire ecosystem, whether it is their consumer, customer, whether it is their supplier, whether it is their vendor, whether it is their associates, whether it is their employees, they all are digitally connected. And to keep them digitally connected, you need to invest in the technology, which probably means that you will have to go on the cloud side, right? Now to go cloud, which means you need to have a lot of data migration. Most of this data migration has been happening, but a large part of the work is still work in progress. So our sense is that this will happen sooner rather than later because you can't postpone it beyond a point because it's going to start hurting your business and the overall entire workflow, right? The other part is also, of course, implementing AI for most of these enterprises is also very critical thing, right? Because there is a security layer, there is worry about how the data privacy remains and all of that. So again, there you are going to need these service providers for implementing AI out there, right? So our sense is sooner rather than later, we will see this spending coming back very strongly. And if that actually happens, the whole narrative today that we have as far as this IT services revenue is not growing will probably change for at least 12 to 36 months. And that is when we will see very decent upside in terms of the stock prices. So from the current valuations, today the risk reward is very favorable. That's how we think about it.
So one last question, and we can end this session. I mean, it is about the IPOs. With many IPOs expected to be coming in right from NSE to Reliance Jio, Zepto, would you be eyeing on any of them after their listing?
So, Pritam, I'll tell you what, every business investment opportunity is something what we evaluate, right? So,
Correct.
every IPO which is worth its evaluation, we are always, we closely study each of these businesses. We meet their management during their road shows. That's a continuous process. But that doesn't mean that we jump and we invest immediately. There are, in fact, our entire portfolio of Capital Builder, if I think about it, we would have invested much later since we would have started tracking or liking that business, right? Because a lot of things have to come into play. We need to get the right price, we need to get the right comfort in terms of the companies building their track record, right? So a classic example is Eternal. We loved that business during the IPO itself. We were fairly confident because that time it was only Zomato food delivery business, and we were fairly confident about that business outlook. And we were very happy to invest that business at around an IPO price of about 85 or 90 in that range, plus minus. But the IPO listing price, okay, and after that, it was at significant premium. In fact, it went to almost 2 times, almost 160 rupees in the run up. We just couldn't participate, and we don't like to just chase, or we don't just like to invest for the sake of investing. We want it at the right valuations. Fortunately for us, in the next 18 months, the stock price came back to 85 rupees and much below that. That's when we actually got an opportunity to go and invest in that business. What I'm trying to tell you is, yes, a lot of good businesses are coming into markets. We continue to evaluate them and will continue to evaluate. When will we invest is the function of the opportunities that are offered to us at that point in time.
Yes, I got a point, sir. I think we can conclude today's session. Thank you so much, Sachin, sir, for your time and sharing your views with us. That is much needed, I believe, in this current markets. I'm sure, along with me, both our partners and clients would have gained meaningful insights from this. Thank you so much, participants, for sparing time on this Friday evening. Have a happy evening. Thank you. Thank you so much.
Great.